All right. Well, I'm showing 901. Let's go ahead and kick off with this month's edition of the Aftermath. Thanks for those of you that hopped on today and those of you that are going to watch later. We've got a lot to talk about today. We finally had a USDA report after 2 months. So we got caught up there. They got a lot of catching up to do on some other reports like export sales and some of those numbers that'll come out eventually. But I did want to, this is the chart I showed you just a minute ago. This is tariff dollars that have been collected in the United States, or import duties. So I thought that was an interesting chart I saw the other day. And the significance of this, I guess, for us is that the president says that maybe he's going to distribute some of this tariff money back to ag producers to help for making up for maybe market loss, whatever the case is. So we'll see if it does happen, but that I thought was an interesting chart to take a look at. Also saw this the other day from over the weekend from Susan Stroud, showing the changes in futures prices, not just over the last week, but over the last year to date, and then over the last 12 months. And I thought it's kind of interesting to look at some of these, which markets have done really well and which ones have not. I know there's been a lot in the press about ag markets being down. But you look at soybean prices right now, we're up 9% year to date, 8.8%. Corn running 3% down year to date. Wheat certainly has a struggle so far this calendar year. The cattle market, despite the big sell off over the last month or so, still up 22% year to date. You can see some of the other markets down below. So kind of interesting to track and see what's going on in the big picture instead of just looking at what's going on each day as well. So I want to start out, we'll talk about markets, and then we'll talk a little bit about insurance and the government programs. This was from the first page of Friday's WASDE report. Kind of got a lot of attention over the weekend that they put the note at the top that said, due to the lapse in government funding from OC1 to NOV 12, some data sources that are typically used were not available for the November WASDE report. So some people were saying, well, why did they even bother putting out a report if all the information wasn't available? Then Lance Honig with NAS did say that NAS itself did have everything that they needed to come up with the numbers for production. So maybe on the supply demand side, there's still some information that they didn't feel they had, but on the production side, they claimed that they did. So I guess that tells us that the yields that they came out with should be accurate according to what they're telling us. So I've been asked this, and so I found this and thought I would share it. How many samples get taken for the report? If you look at surveys for ag, 6,692 surveys get turned back in from producers. Field surveys, field checks, 3,090 for corn and soybeans. So I think that's kind of interesting. And I mentioned cotton up here, 479 gens report as well. So what does that look like when you look at the surveys by state? You can see here this map shows that 6,692 farmer surveys that were turned back in. Kansas wins the award for the most turned back in. I'm going to guess that means that a lot of people in Kansas didn't like their yields this year. Usually that's the way it seems to be. If you got negative news, you want to share it. So we'll see. But thought this was kind of interesting, and it's not down that much from what we saw back in September. I think the September one was a little over 7,000 surveys. So we're not down a lot. So shouldn't have been lacking a lot of information this go around. So as far as the report went, I think this pretty well summed it up. Friday is buy the rumor, sell the fact. Markets rallied into the report on Friday. We got the report. I would contend that the numbers for the most part were kind of a non-event. They really didn't give us any big news to speak of. Maybe we didn't see as big a cut in the yield in corn as what maybe some thought, but but all in all, the report was really almost a non-event considering it had been 2 months without a report. So the markets traded lower following it. Now here today, we're back higher once again. We'll talk about that here in a minute. But as far as the summary goes, you look at corn and beans. Corn yield came in at 186. That was down just 7/10 of a bushel from back in September. Was 2 bushel above the trade average guess. The yield 53 bushel on beans. That was down a half bushel from back in September. So they're going the right direction, but not maybe as big a cut as what some people thought. Now, we don't have a production report in December. The next production report will be the last one that comes out in January. So the government always takes 60 days to come out with their final numbers. Kind of interesting to look back. Karen Braun shared this, showing the changes from November to January in corn and bean yields. And kind of interesting, especially in beans, you look at since 2015, we've had what, 2/3 or more of the years we've seen the yield down pretty sharply from November to January. Corn been kind of hit and miss. Looks like a little bit more apt to see a lower yield in January than a higher one. So we'll see what happens come January. But again, we don't get production numbers in December. So we got 60 days, the government does, to figure it out. And then, of course, they can change it down the road at some point if they decide they want to, too. That's what's called residual usage. So, but we'll see what happens between now and January. U.S. ending stocks. Corn still a big number, 2.154 billion. That went up 44 million. Beans went down 10 million to 290. Wheat went up about 60 million bushels. So it was a little bearish to wheat, bearish to corn. Should have been neutral, maybe a little bullish to beans, but all in all, we know that the markets did trade lower on Friday. South America, I'm not really going to talk about them today from a production standpoint. Crops getting planted. I did see this morning 71% of the beans in Brazil are planted now, so things are off to a good start. The early estimates are still for a record bean crop in Brazil. Argentina is expected to bounce a little bit this year, so we'll see. But all in all, nothing really to talk about there yet. Now, I think that'll be a market factor as we get into December and January. So let's start out with soybeans today because with the government closure, beans have really had the most attention, I guess you'd say. And this series of charts that John Newton with Farm Bureau shared, kind of interesting, talking about the phase one exports to China. You can see what's happened. And since the phase one trade deal, we did see a bounce in dollars, at least for the first couple of years. And now dollars have gone back down once again. So that part of the reason that I think the U.S. government wanted to get another deal done was to hold China's feet to the fire, so to speak. So this latest round, according to our government, China's going to buy 12 million tons of soybeans this year. They're going to buy 25 million tons each of the next 3 years. I would contend if that 25 happens, that's remarkably good, to be honest, because you can see the trend. I mean, the trend has been lower over the last few years. And I think that we've anticipated that trend would continue because Brazil's planting more and more acres every year. And so they're going to have more and more cheap beans. And we anticipate that U.S. bean shipments to China would drop. Therefore, we needed to use more beans domestically, and that domestic crush was going to rise. It's expected to rise over the next 2 to 3 years. So if our domestic crush rises, but Chinese bean demand stays constant, I think that's a very big positive to soybeans. Now, do you really believe this 25 million tons is going to happen in year 3? I don't know. I tend to be a little bit leery of thinking it might, but if it does, that would be a pretty good deal for U.S. soybean producers. So I saw this. I thought it was kind of funny. China will buy zillions of beans this year. U.S. beans, right? U.S. beans, right? We're all waiting for the announcements. They came out with, a month ago with the deal supposedly announced, yet we've only seen minimal announced sales at this point. The administration still saying over the weekend that sales are going to happen sometime over the next few months. We'll see if it does. But there's reasons why China really doesn't need to buy U.S. beans right now. One of them is supplies. You look at their stockpiles, reportedly, around 8 million tons of beans right now. They're sitting on a lot of soybeans. They've been dumping a lot of South American beans coming into the country over the last few months. They've imported more Brazilian beans in the month of October than they ever have. Part of that due to the U.S. tariffs situations. So they bought a bunch of Argentine beans recently. So we know they've got plenty of beans on hand. And the trouble thing about this is the time where normally you would see U.S. soybeans going into China. October, November, December, January are the big 4 months. Well, we know October didn't happen. November, maybe there were a few sales announced, but not a lot. So are we going to make up for it in December, January? Do we need to make up for it? I guess that's the other question, and we'll talk about that here in just a second. So going back to the report on Friday, these were the state yields in the report. Overall, 53 bushel an acre, down almost 1% from last month. You can see the red states went down, blue states went up. So the Eastern Belt especially was lower this month. A little bit of a decline in the upper Midwest as well. So all in all, by the way, the states with a pound sign would be records. So you can see through the heart of the Corn Belt, Iowa, Illinois, Wisconsin, looking at record bean yields here this year, Oklahoma as well. So where did the report come in? Right about the middle of trade guesses on production. So it really wasn't a report that should have had much directional pull, yet I think because we rallied so much going into the report that really we had one direction to go after the report, and that was to see some selling. So looking at the balance sheet, these are the numbers that changed. There's one other one I didn't add or didn't color on here, and that was beginning stocks. Beginning stocks did drop from 330 to 316 because that was the September 1 grain stocks report number that came out right before the government closure. So we did take beginning stocks down a little bit, took yield and production down. So total supply of beans, you can see down about 150 million from a year ago. The only number they changed on the demand side was exports. We dropped at 50 million bushels. I would assume that's in line with the fact that we didn't have any Chinese sales on the books heading into November to speak of, and so, or at least heading into fall. So you can see already that we've shaved off 240 million bushel in export demand to account for, I think, lower Chinese demand this year. The question is, where does this go from here? Does it go down more? Does it stay where it's at? Is this assuming that 12 million tons of beans get sold that we promised, I guess? That's, I think, the big question that we've got as we go forward. What's actually in this number? And I'm looking forward to seeing some analysts dissect that number a little bit harder over the next few weeks. But ending stocks at 290 million is a little bit snuggish. You can see the last, the 2 years before when we were down below 300 million, you had prices substantially higher. Now, we were coming off of a very high price back in 2020, but still, you would think that would mean higher prices. And the government did raise the average farm price 50 cents to $10.50. So big question mark going forward. Does this 290, do we even need this number to get bigger? I would contend that we really don't need to sell China a lot of beans this year. And I know it's been getting a lot of press over the last several months and, because of the tariffs and such. But, given the fact that we planted 6 million less acres of beans this year, given the fact that production was down, given the fact that crush is up 110 million bushels, if you sell China another 100 million tons of beans, you probably take beans into the teens again on price. So I don't think that needs to happen. Certainly, we would like to see some sales, but from an ending stock standpoint, you could get snug pretty quick if we were to see some big movement of beans to China. So export inspections have been weak as expected. Over the last couple of months, this marketing year, we've been well below where we normally would. We have made up a few sales to some other countries. While China didn't buy beans, we've sold a few more beans to some other nations that normally don't buy a lot of U.S. beans. Spain was buying beans. I'm not sure what. There was a Central American country that I think had bought some beans as well. So we have made up a few, but we would expect expect as we get into later November, December, that this is going to perk up a little bit, hopefully, with some Chinese boats being loaded. And just another way to look at this, if you look at the cumulative loadings so far this year, 326 million tons, the lowest start we've had since the drought year of 2012. So pretty weak numbers getting started. So what's going to happen going forward? Well, couple of things are going to change likely. Number one is going to be the yield as we get into January. The second one could be the demand. But as we look at our stocks matrix, where we sit today at 53 bushel an acre with 80.3 million harvested acres, we have a carryout at 290 million bushels. If that yield were to drop a little bit, we drop a half a bushel an acre off in January, takes us down to 256 million carryout. If demand were to change, if we were to drop 50 million, let's say, then that raises stocks. So this is where the stocks matrix comes into play. I don't expect USDA to make much of a change in acres between now and January. If they change acres, it's probably going to be at the end of the next marketing year, maybe in September or something. So I think we're down to really two things at this point. Number one is yield, and number two will be export demand. And how does that all translate when we get to January crop report? As of today, and kind of looking back at the demand thing, as of today, there's no reason that China should buy U.S. beans other than a commitment. But if you look at price today, spot delivery, Brazilian beans are still a lot cheaper than U.S. beans. The rally in beans has really kind of made this happen. This dollar rally we've had in bean futures has really made the U.S. uncompetitive right now going into China. And as you look at the prices out over the next couple of 3 months, beans are still, you got Brazilian beans in green and U.S. beans in pink. Right now, there's no reason that China should buy U.S. soybeans. So I know the administration said over the weekend, I think Scott Bassett said that by spring we'd see beans sold, but you probably need to take bean price down in the United States or rally Brazilian price to make that relationship work to where China really wants to step in and buy U.S. beans. So will it happen? Well, another factor is tariffs. You've got still a 13% tariff on U.S. soybeans, above Brazilian spot price. So there's a lot of things going on right now that would favor not selling beans to China. U.S. Brazil ag exports hit a record in the month of October. So a few pieces of news here that have been not favorable. And as you look at Chinese bean imports, they've been a record really from May now through September. So that explains that big stock number that I showed you just a few minutes ago. Yet the funds have been buying beans. It's estimated, we haven't got a commitment to traders report here since the end of September, but it's estimated that the funds are long about 100,000 contracts of soybeans right now. All enthusiasm over the trade, suspected trade deal with China. So we'll see if it does, how much of that does come to fruition. And you can see the impact of that fund buying. We've taken beans from the low 10s in January futures up into the mid 11s. This morning, after a lower opening overnight, we rallied beans. We were up 20 and a quarter when I did the chart. I think we were up about 17 when I walked in the room. So beans are higher. We haven't gained back all of the loss from Friday, but we're sitting back above the 9-day moving average line again. So that's a positive. I've got beans. I'll have beans in the hot zone again this afternoon with the RSI in the mid 60s, stochastics up in the 80s again. It tells me it's still a good time. If you haven't sold all your beans yet, still a good time to reward the market in a rally situation. One thing that might be bothersome would be this chart gap that we left back here around 1160 or so. 1070 to 1060. Oftentimes we try to go back and fill these gaps prior to expiration. We'll show corn in a minute, how we did that. The 4th of July gap, we filled it in corn. So if beans, if the sellers decide to jump back in the bean market, maybe we go back and try to fill that gap at some point in time. For the moment, I had mentioned, I think in one of my letters last week, that as long as we're above the 9-day moving average, that's a positive for the market. You could even say that the 20-day moving average now, if you're sitting long and you just want to ride this thing, maybe you look at some of these moving averages, maybe the 20-day, and you say, as long as we trade above that, as long as that's moving higher, I ride the wave. And if we get a close or two below that line, then maybe that's my sign to liquidate. Something like that might be an effective way to market in this kind of a market. I've seen some people talk about minimum price, sell by a call. I think that makes sense. You can buy puts if you want, and just ride on the beans. If you want to wait on the basis possibly in your part of the world to improve, that's a way to protect price as well. But anything at these levels, I think, does make sense. The carry is evaporating quite a bit. If you look at January futures to July, that carry was out over 40 cents not too long ago. Now we're down below 30. So we've seen quite a bit of the carry come out of the market. Tells me there must be some cash demand. Well, part of that I think is due to the harvest being done, but I think you're finally seeing some cash demand out on the coast that's improving basis levels to the west as well. So some things that are affecting the carry. New crop next year. What do we do there? Is there anything to do at this point in time? Couple of things I would mention. We are trading above the margin coverage option price now by about 40 cents. So we've improved on that. We bought that. Some of us did as a put option. And it's still, who knows? We don't know what February insurance price is going to look like. But at this point, we bought it as a put, and in case the China deal didn't happen, it looks like it did, and we've gotten a rally. So I do think it's not a bad time to be locking in a few beans for next year. Maybe you sell that 9% or whatever with the margin policy. Maybe you lock that in at a higher price now that the market has trended higher, or sell some additional bushels. RSI stochastics would tell us it's not a bad time to be making a sale. We're still trading above the 9-day moving average. So it tells me, too, that I think that beans are probably going to buy more acres, given the price movement now relative to corn. So there's a lot of reasons why I think it's a good time to be selling a few beans for next year. Flipping to corn, looking at the map on corn, the blue states got better, the red states went down. Overall, U.S. yield at 186, still a record high. We still see several states with records: Indiana, Illinois, Iowa, Wisconsin, all the ones with a pound sign, Virginia, South Carolina, Georgia, all records expected this year. So we'll see where the final numbers come out in January. Production-wise, a record 16.8 billion bushels of corn, still in the forecast. So I know a lot of people trying to talk that yield down, but the government seems real stubborn to bring that number down. And as far as where the production came in, it was above all of the average guesses. So consequently, a little bit bearish to the corn market when we got the report on Friday. So the two big numbers in the report, they did make several changes. One that I did mark on here was beginning stocks did rise over 200 million bushels from that end of September stocks report. So that added some negativity to the corn market several weeks back. But you're still looking at production at 16.7 billion. You're still looking at total supply of corn supposedly at 18.3 billion. So that's the negative. Now the positive is export demand over 3 billion bushels. That's a record. And so this just continues to march forward. It's continues to be very amazing. Ethanol demand, I think, is going to stay strong. The feed number, if there's anywhere the government's going to cut down the road, I think it's in this feed number, just because of the animal numbers just not being there. And I don't see how we're going to feed 600 million bushels more corn this year than we fed last year. That just doesn't jive with the cattle numbers right now. So I would think down the road, if you're bullish because you think the yield's going to come down and the production number is going to come down, in USDA fashion, I would think if they cut numbers here, then they cut this feed demand down here. So odds are still pretty good that we still end up with 2 billion bushels of corn carry out as we go forward. So corn, maybe not bullish at this point, but average farm price did go up a dime to $4 in this report. But the export demand is incredible. You look at export loadings. Now, part of the reason loadings are so strong on corn is because we're not shipping as many beans. So you've got elevators at the Gulf that are willing to take smaller corn margins just to load boats. They want to stay busy, and with the lack of a bean program this fall, they've been selling the heck out of corn, and you can see what's happened so far. It's been an incredible start to the marketing year. And this shows the same thing. Cumulative corn shipments so far, record high, 540 million tons. Conversely, the milo exports have been one of the weakest ever at this point in time. So I know there were a lot of people looking for some sorghum numbers to China when we struck the trade deal. We didn't really see much talk about sorghum, and that's got that market in the Southwest not in very strong shape right now. As you look at the yields, by state, I thought I shared this with beans, but I guess I didn't. But you look at the corn numbers well, I did have the map, I guess, so it's got the same numbers on here. But you can see the change from September, like in Illinois, up 2 bushels. You can see South Dakota, Kansas saw some of the better jumps. You can also see the states that were down the biggest: Michigan, Tennessee, Kentucky, some of these double-digit drops we had from last month. So what's going to happen going forward? Well, here's our stocks matrix, and we're sitting above 2 billion carryout. The estimate at 186 was the highest that anybody in the industry put out going into the report. You can see the lowest number was 181.7. If that would have happened, and if demand stayed the same, you could have taken stocks down into the 1.7s. As it stands today, we're still sitting up here at 2 billion bushels. To get us below 2 billion, you probably need to take us down to 184 on the yield, or make a change to the demand side of the equation. But I still think going forward, if USDA lowers yield in that final January report, they're probably going to lower the feed demand as well. So the positive, I think, on corn right now is at the world level. U.S. stocks are big, but as you look at world ending stocks and you look at carryout to usage at the world level, things are tightening a little bit. And that's probably the reason that we're seeing such good corn demand for the U.S. right now, is that we've got some countries that are tightening up a little bit. Brazil domestic demand is part of that. The fact that they continue to increase their ethanol production, that's a big deal. And so they're not really a competitor with us now in the export market like they might have been a couple of years ago. So as long as they're cranking up more and more ethanol, that's a positive for us. And I think that's brought some demand here back to the United States. So here's where the funds are estimated as of this last weekend. This is from Karen Braun, now with Zaner Ag. They're estimated to be short around 60,000 contracts of corn. So they bought back their beans short. They didn't buy back the corn short. And biggest reason for this is still the size of the corn crop here in the United States, and the fact that the funds are really not wanting to be aggressive. So as we look at March corn, it's really been a nice rally off the low. We set our low early. Very similar pattern to a year ago, making that low about the second week of August. Did not have the summer weather rally that we typically had seen for the second straight year. And now things have bounced back a little bit. We bounced back to 457, took out the 200-day moving average at the end of the week briefly. And then on Friday, we went back below it again, took out the 9, went all the way to the 20-day. Overnight, we traded lower initially. Now we're back higher this morning and pressing back against the 9-day moving average at 447. So that would be a great feat if we can close above it at the end of the day. I do think this 200-day moving average, though, was a sales signal for a lot of folks, and me included. I was hoping we could get back there. The first target that we had marketing-wise was back here, this little gap that we left on July 5th. We took it out finally here in September, took it out again here recently, and actually on December corn, we did not take it, did not fill it in September. We just finally filled it here at the end of last week, and that seemed to be enough to get some people to sell this market. So with a 2.1 billion carryout, 450 corn's probably not a bad sale if you believe the supply demand numbers. And we had the RSI in the upper 60s, we had stochastics up into the 70s, had this market in the hot zone at the end of the week prior to the report. Probably a pretty good place to be selling some corn. And If you look at the carrying corn, similar to beans, we've dropped what, about a quarter of it out, gone from 36 cents down to 28 from December to July right now. So the market has told us that it's needed some spot corn now that harvest is over and the bins have closed. The market is trying to respond and try to generate some bushels. So I think you've seen basis levels bounce back in some locations, and the board spreads have narrowed as well. So looking ahead to next year, what's going to happen? Eerily similar to last year, prices have been. We set our fall price last year was 440. This year was 456 for insurance. Last year, the spring price in February was 470, and now we've kind of pushed back to that 470 area again. So does it need to go higher? Does it need to go anywhere from here? If we're carrying 2.1 billion corn over, I would contend 470s probably doesn't need to go a lot higher than that. You don't need to buy corn acres at this point. We probably do need to shift acres to beans. I would think that's going to happen where the price relationship is, but so kind of hoping we hold this area going into February at least, where we can get the insurance price set above 470. If you can make money at 470 corn, maybe not a bad place to start trickling a sale. You can see that, the RSI just a couple of days ago was up in the upper 60s. Stochastics were in the 70s, low 80s. So probably not a bad spot to reward the market if we get back up to 470 or so. The high we had back in the spring was 477. So, 470, 475, probably not a bad place to get started with a little hedge for next year. The cotton market, you see the report from Friday, just about every state got better. Pretty remarkable that the yield continues to climb up to 919 pounds, up about 7% from a month ago. So the cotton market you thought it couldn't get much worse, and then it did following the Friday report. Cotton yield 919, the second highest we've ever had. 2021 was the highest we'd ever seen. So despite the big drop in acres this year, we continue to raise good cotton, 14 million bales. That was a big, big jump, and it was right against the high end of any of the trade estimates that we saw prior to the report. So you took a bearish market, made it even more bearish. Production up to 14.1. USDA did raise its export number slightly to keep stocks at 4.3 million bales. That seems to be a stretch that we're going to export over 12 million bales of cotton this year. So that number could be 4.5, 4.6 pretty easily. The average farm price dropped 2 cents to 62 cents here this month. And this was a chart I had showed last month, but it still holds pretty true. The problem we still have is lack of China business. Even with the agreement that we had with the Chinese, the word cotton was not mentioned. We're hopeful that we'll see something happen, but at this point, it doesn't look promising. So without the Chinese book, it doesn't really look like the cotton market's got much upside. And funds, I haven't had this position updated in a couple of months because we haven't had any reports, but funds were short 60,000 contracts of cotton then. And for the most part, I don't see any reason why they've added any length. In fact, I imagine they're shorter. Once we get the next report out, it's probably going to show they've added to their short positions. And you see what happened to March cotton since the report. Made a new low this morning, in fact, down below 64 cents. Very, very oversold, 32 RSI. Stochastics even dipping into single digits right now. Probably more of a buy than a sell. But if you're looking at where to market, I would say, the recent high at 67.5, probably your next best opportunity to the upside, which happens to be just below the 100-day moving average. Then your 200-day moving average, 68.8, probably your next target if you're looking for some upside in this market. Looking at new crop, I really don't have any incentive to jump out and do anything just yet. We're still very, very low historically on price. I would anticipate, I don't know what cotton acres will switch to if they do to anything next year. I know some folks look to add peanuts this year. I know the Mid-South Delta added some corn acres this past year. I would say soybeans in that part of the world probably will be a positive pickup, but I just don't know where the acres will go at this point. So I don't think I want to jump out and sell. Of course, we're very oversold. Can you get back up into this 68, 69 area? Maybe give you a chance to do some hedging. And then finally, wheat. Wheat was a bearish report. USDA lowered planted acres, but raised harvested acres, raised yield, and raised production. Overall, ending stocks up about 70 million bushels to 901 million, highest we've been now in a few years. And the government dropped the average farm price a dime to $5 a bushel. So nothing friendly in the U.S. report on Friday. However, if you look at export demand so far, exports are anticipated at 900 million bushels. That's the highest we've been since the 2021 year. So loadings have been pretty good so far this year. We need them to be. We're seeing a little bit of that happening. We're seeing maybe Russia and some other places around the globe not export as much. And when you look at the world numbers, the stocks to use amongst the major exporting countries, it's still hanging at one of the lower numbers we've seen in a while. So that former Soviet Union area has been in a little struggle. And that's given the U.S. at least a little bit of life here in the wheat market. Funds, they're still short hard red winter wheat. Well, again, we haven't seen an updated position, but I guarantee they're still on the short side. And as you look at the KC March wheat market, we've continued to slide throughout the summer and into the fall. Did get a little rally, and I think the corn market has been responsible for the rally in wheat. Indicators pretty neutral at the moment. We're stuck right in the midst of all these moving average lines right now. Here sitting about 540 this morning. So can you push above the 9 and the 100 again? Maybe it gives us an upside potential to get up to that 200-day moving average at 581. Looking at summer wheat for next year, we set our insurance price at 561. We're setting just a couple pennies or so above that this morning. That's always one of my targets. If you can improve on that, I'm probably looking at the 200-day moving average at 597 as a target to be doing some hedging if we're able to get backed up to that area. Looking at soft wheat, very similar to the hard wheat chart. Funds still short. We did rally 60 cents off the low. Now we've kind of settled into a middling range. But this morning, I'm back above the 9 and the 100-day moving average. So again, I'm probably looking at this downtrend line with the 200-day moving average up around 580 as a place I'd want to liquidate some old wheat. Looking at new wheat, kind of similar. Now, we did leave a little gap in the chart back here in late October, so always keep that in mind. But I still think that if we're able to get back up to the 200-day, up around 597, be a good place to get started, maybe with a little bit of a hedge for this coming year. Finally, spring wheat. Funds very, very short spring wheat, historically speaking. And you can look, spring wheat hasn't even had the rally that we saw in the winter markets, still sitting here in the mid 560s. And in September, new crop next year, we're still above $6, but not very much. So market really not giving us much of an opportunity at this point. So a few of the other markets to look at, just to plug my market report email letter. We always have the heat check column in here and shows the hot and the not markets. On Friday, we took several markets out of the hot zone and back into neutral, corn, gold, and the Dow. You still got the bean markets in the hot zone. You've still got cattle, hogs, and cotton in the not. So if we look at a few of these markets, meal surprisingly has been the one that's been rallying this thing. It's been the strong leg. Now, for the first half of the year, it was not. It was just the opposite. Oil was the rally and meal was the dog. And now all of a sudden you've seen buying in meal. You've seen export sales of soybean meal. So even, I think we're going to, as we go forward, have to watch that a little bit more. In the past, we've just looked at soybeans, but now that we're crushing so many beans in the United States for the oil, I think our meal exports are going to continue to grow a little bit. And so we'll watch that, I think, closer as we go over the next 2 or 3 years and see how meal grows. But that's been where the growth has been in the chart here over the last month or so. Oil has been just the opposite. Oil's been the weak link here lately, and a lot of that, I think, has been fund repositioning, where the funds had been so short meal and long oil, they've been unwinding some of that spread. Going the wrong direction, my bad. Hogs, meat markets have certainly been in the oversold area. We've got this, looks like a double bottom here on the chart. We'll see if it can hold here throughout the day today. But we've pressed back down to the July low here just recently, so we'll see if that can hold. But certainly been in about a 5-6 week downtrend. Can you get back above these moving average lines above 80 cents? And then the next round up at 84 looks to me like a good opportunity then maybe to sell some hogs. In the cattle market, feeders left a chart gap here in late October. That's the target to the upside if we're able to turn this market back higher. As you can see, we're pretty oversold. RSI in the 30s, stochastics down in the 30s and 20s right now. And that chart gap, by the way, sits right at the 50-day moving average. So there's a lot of things lined up that would tell me there's a good opportunity there. Also, a little gap I didn't mark on here, but up around 375 or so. And so maybe that gives us a couple of things to shoot for over the next month or so ahead of expiration of the January contract. In live cattle, the 200-day moving average held so far on Friday. We'll see if it can hold and give this market a turn. But the RSI and stochastics would indicate maybe we're a little bit oversold right now. Still, I showed earlier we're up 20% year to date, 22%. So still a good year to date. Just been a rough 30 days or so. And then finally, crude oil. Crude oil at 60 cents a barrel just kind of seems like a floor. And that's where we're sitting right now. Oil tends to be one of the drivers of the commodity complex. I've mentioned that several times. And so to get the other markets like corn, soybean oil, now so many of these markets participate in petroleum. You'd like to see crude rally a little bit. It's just kind of been a dog lately. I know OPEC increased production at year end. Of course, U.S. production's trying to increase. So I know politically we would like to see Russian oil prices drop. So that's been a target of the government. So, but not necessarily a positive thing when it comes to commodity prices. And then finally, the Goldman Sachs index, despite the fact that you've had oil struggle and despite the fact you've had livestock prices down, you've seen a little bit of a bump over the last several weeks in the commodity index. And so this also takes into account precious metals. Well, gold's at a record high, silver's at a record high. So that's been one of the big pushes here. Soybeans have been rallying, of course. That's a big push as well, bean products. So switching gears, let's look at government programs. Where are we at right now? For 2024, those payments should be being made right now if they haven't yet. The marketing year ended on August 31. And so you can see on PLC programs this year, we only had two crops that would have paid in 2024, and that's peanuts and cotton, seed cotton. You can see what those payments per acre would have been. Peanuts, $19.74, cotton, $44 an acre. Ark County, you can see over here, the second column shows which crops, how much average they would have paid. Well, we can do one better than that. I can show you a map that FarmDoc just put out last week, and I'll let you absorb that for just a second. Pardon my cold. But you can see which areas of the country would have collected for the Ark County this past year. Not through the center of the Corn Belt, southern Minnesota, certainly an area where you'd have seen some big payments, as you would have in the Delta on anybody with corn base. Keep in mind, these are made on base acres, not on planted acres. So it is made on 85% of your base acres. Soybeans, you can see here as well which counties would have triggered any kind of payment dollars this past year. Kind of sneaks up into the Midwest a little bit, but you can see not a ton. Price drop was a big reason that we would have seen some payment on both corn and soybeans here for this past year. So looking ahead, we're 3 months into the marketing year now that started on September 1. These are our current market year estimated prices for 25-26 as of Friday's report. The USDA raised the corn price a dime, raised beans 50 cents. Wheat was down a dime to $5. If you remember, under the big beautiful bill, the government came out and said, we're going to give you the higher of PLC or ARC payments for the 25 crop year. That's a good deal because some may get an ARC payment. ARC is going to be based off of these prices in the red box times your county's 5-year Olympic average yield times 90%. So you can kind of see what the difference is. Now, ARC had a better price. However, if your county yields are strong, that could kick you out of potentially getting an ARC payment. But as it sits today, the PLC reference price are the ones in the light blue boxes. And as of today, every crop would be in the money for a PLC payment this year. So we'll wait and see where prices go between now and the end of August. As of today, we know we're going to get the higher of the two. I would not even, at this point, if it were me, I would just look at PLC. ARC is kind of hard to tell because we don't know where county yields are going to end up. But ARC is going to end up taking this final price times your final county yield to determine if there's a revenue loss. So here is an example, and you can kind of walk through this. I've updated this for PLC on an example of a 1,000-acre corn, 1,000-acre bean-based farm. If you had a 200-bushel payment yield at FSA and you had a 60-bushel payment yield on beans, your corn payment as of right now on PLC would be 42 cents a bushel times your payment yield times 85% of your base acres. In this case, $71,000 or $71 an acre for corn PLC. That was about $79 a month ago. So because corn price went from $3.90 to $4, we gave up some money in PLC payments. So you gained it in the market, you lost a little bit potentially in PLC. Soybeans, because we went up 50 cents, that made a huge dent in the possible PLC payment on your base acres. Still about 10, 11 bucks an acre. So that's where we sit today. We'll monitor this over the next 9 months, especially once we get county yields out. By the way, Kansas State University has a fantastic tool that they continue to update. I don't think they're updating it yet for ARC for this coming year, but they should start here as we get into spring. We've put together a calculator as well, so I can look at a side-by-side comparison. This is not a big deal necessarily for 2025, but for 2026, we're going to have to start making an assumption because we are going to have to elect a program this coming spring. We are going to have to choose for 26 between PLC and ARC. And so you're going to have to say, well, what do I think might happen in the year ahead? Where are our floors under both of these programs? And so this is for 25 examples. So I showed this for Champaign County. I showed it maybe last month, and I updated it here with the price bump. But the PLC price floor is $4.10 a bushel. The PLC effective price, so PLC gets the higher of the $4.10 or 88% of the ARC Olympic average price, which happens to be $4.43. So right now we're working off of that 88% of the ARC trigger, which is $4.43. And so you can see here, if the final price is $4, then you get 43 cents times 200 bushel, the exact same example I just showed you just a second ago, $72,000. For the ARC program, let's say Champaign County's expected yield was 223.7. We do the math. Let's say the county yield in Champaign County ends up at 230. The average farm price at $4. If that's the case, $40,000 would be the payment. So our PLC would pay the most money. So in a position where the county yield goes up 6 to 7 bushels, you're still looking at more money from PLC. So that's kind of why I'm looking at PLC right now for corn, probably for beans, being the most likely to pay for 25 for most people. For 26, we'll wait a month or two before we dig into that, before we start doing the comparisons, because I want to let the market do some work a little bit. I do believe that the 5-year Olympic average price next year on corn will stay unchanged at $5.03. So that'll provide at least a little extra support for the ARC program. But as long as PLC reference prices are at $4.43, then I kind of like that PLC program. What's going to happen going forward? This is a chart the Farm Bureau had put out. The impact of the bump in these dollars for PLC and ARC because of raising these price floors. You can see what they're estimating the payment numbers to look like as we go forward under the One Big Beautiful Bill versus what they would have been. So I think what the big change here is you're going to see other crops besides peanuts, rice, and cotton that are going to start seeing some payments. And that's the orange part of this chart as we go forward. Finally, crop insurance. What are we looking at for 2025? Well, we finalized prices in most states here at the end of October. So you can see the prices, but you can also see the change, which is the most important. That the corn and sorghum price was down 10.2%. rice down 24.8%, cotton down 5.8%. What's that mean? Well, if you're looking at a revenue-based policy, then at 85%, the only one of these that looks likely to pay would be rice. If you're looking at 90 or 95% using SCO or ECO or something like that, then that brings into play the corn potentially paying this year. Cotton with stacks, you would still have to have a yield loss in addition to the drop in the price in order to get below that 90% stacks trigger. For crops, the flour or the oilseed crops, prices actually went up this year because of the rally in bean oil. And so very unlikely you're going to see any kind of payments on crop insurance unless you had a substantial loss in yield. So some of our tools I've got out in the indemnity and profitability worksheet tab. If you go to that tab in our agent portal, we got the SCO ECO worksheet. And here's an example I showed last month in Madison County, Ohio, but I finalized the price at $4.22. And in Madison County, they have an expected APH, or I used an APH on the farm at 205. That 9% band then would be worth about $86 to $87 an acre. And I did the math, backed into the math, and said, the expected county yield is at 197.5 at 208.7, so about 11 bushel higher than the expected county yield. Madison County would start to trigger a payment, 95 cents a bushel, or an acre. So you're starting to see a little bit of money, even with a pretty good yield, because of the drop in the price with ECO this year. And so we can look at the matrix then. And now that the price is set, I changed all of these to 422 because we don't have the price factor in it. And so I can show here, different levels of yields where we would pay. And you can see here it only takes about a 4%, 3 to 4% yield loss to maximize the dollars with the ECO policy at 95% because of the drop in the price. I can also show that between 105 and 106% of expected county yield is where we're going to start to trigger a payment. So we got some assumptions to make at this point. We won't get final county yields until early summer. NASS sometimes in some states and some areas does put out some reports in late February. Early March, I think it was, maybe this year. So we'll look for those down the road. But you guys can kind of get a feel maybe for the yields in your counties. And, where you think you fall into play, you can look in this calculator then and see what the payments might look like. But I do think on corn, there's going to be quite a bit of payment on ECO this year. Soybeans, it won't. We were only down, 1 to 2% on price. So you'd have to have a big drop in the yield, and I don't see that being the case. So thinking ahead to 2026, this was a slide that I've showed several times over the last few months following the release of the big, beautiful bill. The big story for crop insurance this year, you can see some of the other changes, but the big story for crop insurance was the increase in the subsidy. Initially, it was said to be an SCO increase. They also added ECO and MCO too. So now you can get 95% coverage at an 80% subsidized level. So it's going to kind of be a game changer, I think, for some of our decision making. Again, I would invite you to go to the SCO ECO indemnity worksheet tab, and we're going to add the 26 worksheet and matrix here shortly. But what I wanted to show is as of today, December corn's trading at $4.67 a bushel. If that happened to be our February average, we got a ways to go, but if that happened to be the Feb average, and if the price next year went to the same price it did this year, $4.22, and the county yield stayed unchanged, you're looking at $46 an acre indemnities. So, long way to go. We've still got to wait till we get to February, get this price set. But if you still think that, price is going to do its normal thing of going down in the fall, then ECO looks like a pretty good tool again to use. And so we can look at the matrix and I can plug in a range of prices, a range of yields, and you can kind of see where the policy would start to pay out a little bit. So primarily early on, I look at it from a price perspective more so than a yield tool. And if you look back at some of the history of when it would have triggered, this shows ECO and SCO. This is in the historical tab in our quoter, but you can go back, and I ran this all the way back to the year 2000, showing where, and this is in Greene County, I believe, again, the same county I just showed, Greene County, Illinois, showing where ECO and or SCO would have triggered payments over the last 20 plus years. And so you can look at this for your county, make a decision whether you think it's a good deal or not. At the 80% subsidy level, seems like it's going to be pretty tough to say no to, I think, as we go forward. One other tool that we do have available too, I wanted to make sure that everybody knew this producer profitability worksheet and matrix. It's a pretty slick tool and pretty quick to use because it's all on one sheet. I can put in my expected yield on my farm, my county's expected yield, my policy on our revenue protection. Do I buy SCO, which covers, in this case, from 80% up to 86? Do I buy ECO from 86 to 95? I can plug in the total insurance premium, put in my cost of production, and then put in any forward sales that I make. And so I went ahead and said I sold 40 bushel, 20% today at 467 price. And then it's going to show you in the matrix down below profit and loss. And so pretty easy to see where I'm making money and where I'm not making money. Our biggest hurdle right now is the price not moving and losing bushels. If we have higher price and, yay, great, we're going to make money, of course. But you can see where your holes in your plan might be for the year. So maybe I don't want to make the sale. The one thing I did take out of this tool that I had in the past was PLC and ARC money. Part of the reason I took it out because the payment doesn't get made until the fall of the following crop year. So I have a hard time, putting any PLC money in for 26 when you don't get the payment until October or November of 27. You can put that in your head if you want and say if prices stay down, then maybe I've got an extra 40, 50 bucks an acre coming. But I did take that out for that reason. Or you can say that's a bonus at the end of the year and I can take my family to Disney World or something. So however you want to look at that. But this helps to me, I think, to be able to see in one big, one quick picture. If I change my expense number, or if I do this or that, with the policy, here's how it's going to affect the bottom line. And then I can also, down below this in the calculator, I can show different pictures of here's the RP policy portion, here's the SCO portion, here's the ECO portion. It's going to tell you how each of these policies would have paid on its own. One last thing before I skip ahead. December 1 is the last day to buy pasture, rangeland, and forage coverage, PRF, for the 2026 calendar year. PRF, you're buying the monthly increments, the 60-day increments for like Jan, Feb, March, whatever for 2026. You're buying that based on rainfall coverage. So if you're hay and pasture, whatever, you want to buy PRF coverage, you got about 2 weeks to get that done. So with that, what's coming up? Well, we got Thanksgiving coming up in a couple of weeks, so the market will be closed that day. The PRF deadline I just mentioned on December 1. December 9th, we'll get our next WASDE report. However, we will not get production that day. Remember, the government skips December, and they'll go ahead to January with the final production numbers. Of course, we've got Christmas and New Year's. Markets are going to be closed as well. I'll have our next aftermath on December 10th. We don't know the dates yet of our reports for next year because the government's been closed. And so I anticipate shortly they'll be putting out the calendar for 2026. But haven't done that yet, so we haven't got that on this slide. So with that, if anybody's got any questions, I should have told you at the beginning, you can use the chat, but I appreciate you joining here this month and hope you stay safe, and we'll look forward to visiting with you again in December. Take care. We'll talk again soon.